Hey, everybody. Thanks for joining us. Today, we have an awesome loan officer, reverse mortgage specialist, John Wallace, on with us. John, I actually don't know a ton of your background yet, so this is an interesting interview for me. Would you mind sharing what brought you to reverse and some of your experience?
Sure. Reverse became an opportunity for me during the past year when I was looking for more avenues of success in the mortgage industry. So even before I joined AmeriFund, I had been studying reverse mortgage through one of our lenders, and so now that I'm here, joining the class has been exceptional for me.
I think you've really dove in a big way. What has been the most surprising thing about reverse as you've gone through this journey learning about it?
Um, the misconceptions about reverse, how people think what reverse is and what it actually is are two different things often.
Yes, very much so in my experience. So, what do people think it is and what is it?
Well, the first thing people say is it's garbage, it's a ripoff, the bank owns your house, and um, you're never going to get it back. And then you can lose your house, and then your heirs can be responsible, and so on and so forth. Those are some of the big misconceptions that people have.
I experienced those ones too. So, what is it if those things aren't true?
Well, the laws changed. I think it was in 2014, but the no recourse part of the reverse mortgage is very enlightening for people who have these misconceptions. And the no recourse says that if the house has reversed past its equity, uh, that the borrower is responsible, and they're not. That's the no recourse part. If a maturity event happens, if the borrower dies, the heirs are also not responsible for any negative equity in the property.
Yeah, so I use a little different terminology, liability versus responsibility, because the responsible, they still do have to figure out what to do with the house, right? But they're not
Sure,
liable for that debt.
sure, right,
That's
right,
so incredible. Where else can you find a mortgage where the only thing they're going to look to is the property value, the property itself?
absolutely, absolutely. And this no recourse lack of liability is so important in helping people understand that access to your equity during the mortgage is safe as long as you stick by the rules. You pay your property taxes, you pay your insurance, you keep your house maintenance up. And other than that, the bank doesn't own your home. You own your home for the entire time. And this is so important for people to understand.
Right? It's like people hear the word reverse mortgage and suddenly they forget the word mortgage, right? A mortgage is just a lien on the property. But because of the words reverse mortgage, they think, oh, it's so different, which it is different, but it's still just a lien against the property. You're the owner.
That's it. That's
Yeah.
it. And that helps people be a lot more comfortable with the concept, just knowing about the no recourse and just knowing about the fact that it's your house. It's not the bank's house. I think reverse mortgages in the past may have seemed to people to be predatory. And the changes that happened in the laws protect the consumer and protect the consumer's heirs in a reverse mortgage.
Right. And you're absolutely right. 2014 was a big year for change. Prior to 2014, this is a little crass, but it seemed like it was The conversation was, well, you have enough equity and you've got a pulse, so let's get you into a reverse mortgage.
Right.
And they
Right.
didn't check if it was actually a sustainable solution. Can
Right.
you pay your
Right.
taxes? Can you pay your insurance? Are you going to live there for the rest of your life or for as long as you keep this thing? Can you maintain the home? And so people who couldn't do those things were still able to get a reverse. And I think that's where a lot of the misconceptions come from, because in those situations, yeah, if you're not going to keep up your end of the bargain, well, then the mortgage holder has clauses that you sign to, and you have to pay the loan back. And that's
Well,
not a fun situation.
yeah, and that's where financial assessment comes in and life expectancy set asides come in. So before, there weren't these safety measures for the borrower, um, the life expectancy set asides. If a financial assessment says they're not going to be able to pay their taxes on their income, they're not going to be able to maintain their insurance on their income. So the lender makes a calculation that holds those in reserve to ensure that the person has a financial ability to maintain what their obligations are in the loan.
Well put. You really made that very clear analogy of what that is and why that is. Yeah. All right. So we talked about some of the misconceptions. I've got to ask what your favorite feature of the reverse mortgage is.
Oh, interesting question. There are a lot of features. I think that, first of all, in forward mortgages, the opposite of a reverse mortgage, people, especially lately, are looking for fixed rate. And interestingly, in reverse mortgages, about 90% of them are adjustable rate mortgages. And the reason is that it gives the borrower much more flexibility with their equity. And what I mean by that is that um, in a in most cases with a fixed rate reverse mortgage, there's a principal payout at the beginning, and that's the end of it. But with adjustable rate, they have several options. After they get their principal payout in the beginning, then after a year, they may qualify for a line of credit. They may take a term monthly payment to help with bills. They may be able to take a monthly payment for the life of the loan, depending on the equity they have in their house. And regardless of what happens to the rates, with that line of credit, it doesn't decrease. They maintain that line of credit or it increases for them. So there's a great flexibility in choosing an adjustable rate reverse mortgage. You might say it's the reverse of a forward mortgage in that aspect because the adjustable rate gives them so much more flexibility.
It really, really does. You touched on a really important point. 90% of reverse mortgages are adjustable rates. That's amazing.
Yes, yeah, it is. But it tells you something. It tells you something that people have more opportunities, they have more flexibility, they have more access to their equity over time, as opposed to a single payout at the beginning. Look, with both of them, as long as you stick to the rules, you're never going to pay a mortgage again. Your mortgage payment is done. So this is a benefit of both fixed and adjustable rate mortgages. But with the adjustable rate, you have those other options that make it so attractive. That's why 90% of the reverse mortgages are, in fact, adjustable rate.
Mind blowing for people who think, oh, adjustable rates are terrible. And I want to go into a little bit why people have that mindset without really understanding why. 2008, 2009, I think adjustable rate mortgages got a really bad rap, maybe justifiably so, maybe not. But those mortgages were done in large quantity with people who didn't really understand what they were getting. And those forward mortgages with adjustable rates had a payment tag to it, right? If there's a payment and there's an adjustable rate, when the adjustment happens, that payment adjusts. With a reverse mortgage, there is no monthly required payment. Now, you can make payments, as we know in the industry, most people don't. And
Sure.
if you want to, send a payment in. It'll help your equity position. It'll help your line of credit grow. There's lots of reasons people do make payments, but you don't have to. And so the idea of the rate adjusting is not the same. And it's not at all the same product. It happens to be the same name, adjustable rate mortgage, but the way it works is so very different. I wish we had different language for it.
Yeah. Yeah. People hear ARM and they're immediately on guard. But with a reverse mortgage, when you lay out their options for them, that alarm dissipates. They see that they have more potential for being able to use the equity in their house for repairs, for even a trip that they've wanted to take all their life, a second honeymoon. And that's the flexibility that the ARM in a reverse mortgage gives you.
It's such a beautiful thing. I think you touched on something that I wish more people considered. You probably hear this all the time. We hear the language of, I don't need a reverse mortgage, or I need a reverse mortgage. And what so many people don't think about is, what if you wanted one? Now, John, I know you talk to your clients about this. What are some of the reasons people want reverse mortgages, not necessarily need them?
Well, I think a lot of retired people have planned very carefully what their income is going to be monthly. And what happens is that they're doing okay with that. They're paying their bills, they're staying at home, and stuff happens. A new roof, and they've got to refinance their home, but they're on retirement wages and they may not even qualify. They want to do something special. Excuse me. they want to do something special in their retirement. They want to travel around the country. They want to buy an RV and go away for a month or 2 months. They got to come back because they got to be living in that house. But these are some of the things that they don't have to do, but a reverse mortgage can allow them to do. And especially now, where we're looking at 8 to 9% inflation over a year ago, some of these retirement monthly incomes are being stretched. So they get to do less and less. They get to go out with their friends less and less. This is a huge thing. When you have to leave your peers behind, when you have to leave your friends behind because you're watching every penny, something to help out would eliminate that isolation that many retirees feel, especially when inflation is involved.
That's such a good point. When you study the aging mind, isolation is a really big problem for physical and mental wellness.
It's huge. It's huge.
Have you encountered that in people in your life?
Yes. I've encountered it with my siblings who are retired and are okay, but may not do the things that they want to do in retirement, or may have to stop being social. This is huge. Being social, we're social all of our lives, and all of a sudden in retirement, we have to count our pennies and we get less and less social. And that's a tough place to be in. In a reverse mortgage, might be able to solve some of those problems for people.
In a big way,
Yeah.
in my opinion. Okay, so how can it solve some of those problems? What are some of the ways you've seen a reverse mortgage free someone up, someone who's not desperate, but someone who really could socialize some more or do some more activities? How can the reverse make that possible for them?
Well, there's a couple of ways, and we've mentioned them in regards to a cash payout at the beginning that gives you a bigger boost in your savings so that you don't feel quite so cramped. You can get that in either the fixed rate or the adjustable rate mortgage. You can also figure out a monthly payment that you're going to receive for any length of time up to and including the length of your reverse mortgage until a maturity date, depending on the equity in your home. You can do that for a term, 5 years or 10 years, you can receive so much a month, again, depending on the equity in your home. But these are some of the things, if somebody finds themselves restricting their activities because they don't have enough each month, this may be a huge break for them.
Well put. Well put. And in my head, I can hear the audience going, yeah, but I want to leave my kids as much as possible. And to that, I've got to say, and I'll ask your opinion on it, but I've got to say, do your kids really want you to not be socializing? And do they realize that might affect your auditory and your brain processing and lead to other conditions that are not so fun?
Well, this is a conversation first that you have to have with the borrowers and their heirs. Do they expect to leave this house to their heirs when they're gone? If they do, perhaps a reverse mortgage isn't the right path. But if you have the discussion with the borrowers and the heirs that you're asking the borrowers, is your life what you want it to be? If it's not what you want it to be, what do you want it to be? Do you want just a little more flexibility? Do you want a lot more flexibility? Do you want to be able to, again, travel or be able to see your friends as often as you used to see your friends that you're not seeing them now? And these are the discussions that you have to have with the borrowers and their heirs. It's so important.
I love that you bring that up because a lot of people don't talk to their heirs. They just assume, oh, of course they want the house. Well, okay, do they want the physical house? Is one of them going to move in, or do they want the equity in the house and they're likely going to sell it to get that? And
Right.
that, two very, very different situations. And
Absolutely.
for the heir, this is a cool story. For the heir that is of age, I've actually done this twice. And surprisingly, it was a mother and son in both situations where the mother had a reverse and she passed and left the home to a son. And the son wanted the home. He wanted to move physically into the home. And so he was age eligible and there was enough equity. So we did a reverse refi into another reverse mortgage for that son. So even if that's the case, it may still be possible. And having that open line of communication, I think, is just vital in this situation.
Yeah. And you have to, as you said, you have to find out what's the motivation behind uh, being afraid of a reverse mortgage as an heir. Some people buy grandma's house. I did a purchase loan for someone whose grandmother had died. The family had 3 different residences nearby uh, from 3 different of the grandchildren, and one of them couldn't imagine not having grandma's house for holidays, so they bought it. So I understand that motivation. And that's one of those things that you really have to consider whether or not the reverse is correct. Because if there's no equity left after a maturity event, and what I mean by a maturity event is if the borrowers decide to move, or if they pass away, or if they go into a care facility for more than a year, that's a maturity event. So they really have to discuss the reasons why they're concerned about what happens after a maturity event. And they may not be concerned. The children may be fine, they may be well off, and they also may be concerned about their parents' lack of flexibility in their lifestyle in their golden years. And this is a perfect solution for both the heirs and the borrowers.
And that's so misunderstood. People think it's one or the other. And I
Right.
want to go back for our audience who doesn't know the significance of a maturity event. What happens when one of those events happens with the mortgage? How does that relate?
Well, a decision has to be made. If there's a non-borrowing spouse, for example, my wife and I are 10 years apart. She's younger than I am. She wouldn't qualify on her own for a reverse mortgage. And so if I borrowed without putting her on the loan, then a maturity event, again, might be my death, might be my having a stroke and going into a retirement facility. At that point, the non-borrowing spouse has 6 months to dispose of the house in however she wants to do it.
Can I frame that language a little bit? It's just pay back the mortgage, right? She doesn't
Right.
necessarily have to dispose of the
Well, she could
house.
she could sell the house. She could sell the house. She could decide to refinance the house. Um, and at the end of 6 months, if the stuff hits the fan, there can be extensions available of 90 days twice. So conceivably, after a maturity event, the people involved in the ownership of the house have some time to figure out what to do.
And that was a great example. And I think you were assuming you were on a proprietary or a jumbo. But if we actually did a HECM, the FHA kind, now there's lots of reverse mortgage types, if you guys aren't aware of that. If we did the FHA kind, we would actually declare your wife as what we call a non-borrowing spouse. And then she could be eligible for a deferral so that she's not a borrower. If you had a line of credit or a 10-year payment, that would stop. But she could remain in the house until her maturity event, where she sells, passes away, moves out of the home permanently.
Great point. Great
Yeah.
point.
So
Yep.
flexible.
Yes, it is. Yeah, FHA is that's one of the great benefits of the FHA. Jumbo's a little bit different, but the home equity. Um, I'm sorry, the HECM for FHA is gives added safeguards
You don't
to
need to
them.
apologize. The HECM sounds like a cough, like a
Yeah, it
I
does.
wish I could rename it, right? Home equity conversion mortgage is a
Conversion mortgage.
mouthful.
Yes, yes, yes.
Heck'em, heck'em.
Sounds like Gollum,
Yeah. All
right?
right. Well, I'm loving this. And obviously you guys can tell how John works, his passion behind it. I do have a couple of questions I still want to get to. So what are the potential benefits and risks of doing a reverse mortgage?
Well, I think we've talked about a lot of the benefits. Being able to use your equity when you may not necessarily want a forward mortgage or be able to qualify even for a forward mortgage. The risks are that if you don't pay your taxes, if you don't pay your homeowners insurance, your hazard insurance, if you don't keep the house up, then the bank can call the note. You own the house. You're responsible for the property. This is a risk. But it's also quite clearly stated throughout the process of the loan. And there are safeguards like the LISA, the life expectancy set-asides, that if during the financial assessment, you don't show the residual income to be able to pay these things, then they work it into the HECM. Then they work it into the reverse mortgage. And this is such a cool feature, safety feature, that's been added to reverse mortgages so that people don't get in that trap. So there are some downfalls. You have to stick to your obligations. And there are some safeguards to help you avoid those. So,
Yeah, really well said. I mean, with any situation, any financial tool, there are going to be risks and there are going to be benefits. And in my opinion, one of the biggest risks is that you pass away immediately, right? You put this thing in place and then you pass away and you didn't get the value of it. But at that point, do you care?
well, you don't care, but your surviving spouse or your heirs, you haven't spent all the equity in the property. It's a tragic situation. I'm dead. So I don't care. But when that happens immediately, you're still going to have equity in the property to either support your surviving spouse in whatever way he or she decides they're going to take advantage of that equity, or if it passes to your heirs, they have equity. They can sell the house, they can refinance, they can use that equity to benefit from your passing. And it's kind of an odd way to put it, but that's really what it is. When you've signed off on a reverse mortgage, you don't immediately lose 100% equity in your house. It takes a while. It takes a life expectancy. And when you immediately pass away, if I croak tomorrow, my wife has most of the equity left in the house. So,
That's a really good point.
yeah.
Really, really well said. Yeah. So, I mean, that is a risk, but also it's a benefit. And that's a good point, too. We sometimes have people who are saying, why can't I borrow more? And I think you just answered that. There needs to be equity, right? You're not making a monthly mortgage payment. So, what happens? The interest just accrues little by little. There has to be room for that. The other
Well,
part, oh, go
yeah.
ahead.
And the bank, when they figure out the lender, when the lender figures out what your initial payout is going to be and what your line of credit is going to be and what your life expectancy set asides are coming out, what they're figuring that you're going to live to that full life expectancy. So the equity isn't gone when you die prematurely. And often the equity isn't gone when you die at life expectancy because the house continues to grow in value over time. FHA estimates 4% a year. So that covers growth. So it doesn't mean that you're not going to have any equity left if you live to your life expectancy.
Right.
It depends on what's happened to the market. It depends on whether you've made some payments to continue stabilizing and growing the equity in your investment. If you find out after 10 years, you're 75 years old, you don't want to travel anymore, you're cranky and you want to stay home all the time, and you don't need that extra money, you can put money back into it and have that equity there for your heirs.
And another situation, a lot of the time when we model those amortization schedules, long-term care in home, the situation you just said would be perfect. Stop the payments, let the line of credit build up as it grows, so that if you do make it to 95, right? Hopefully it's not that 75-year-old. Hopefully they're waiting until they're 85, 95 to stop doing things. But in any case, it's there for them. It's in my opinion, kind of a personal insurance that you've created for yourself.
Right. And a lot of people use that initial payment or the line of credit to pay for long-term care or long-term care coverage. They might still be very healthy and worried about what happens when I'm not. And this is another great use of that line of credit or the initial payment is to set up that long-term care.
Yeah, really, really good point. It all plays together, right? This is just one piece of the retirement financial puzzle. It's not the only piece, but it shouldn't be ignored either.
Right, right.
All right. So, on that topic, we are going to wrap it up here in just a minute. But, John, I have a question for you. If you could change the outlook on retirement for Americans specifically, how would you change that?
I'd eliminate inflation immediately because I know how to do that. Nope, just kidding. I think for so many Americans, retirement is scary. They're looking at, I don't make 5,000, 6,000, 10,000 a month anymore. I'm on a lower fixed income than I used to be on when I was employed. What I'd like to change is to have people be able to realize the quality of the life they had before retirement. And I think that is one of the great opportunities available with a reverse mortgage for a lot of people.
I love it. Let's get some fun. Let's get some life quality back in there, not just focused on how do I make it work in this little tiny fixed income window.
Oh, yeah. Oh, yeah.
All right. Well, thank you so much for being on with me today, John. If
Oh, it's
anyone
great.
wants, oh, if yeah, I love it. If anybody wants to work with John, there's going to be a link right underneath this video where you can submit a form and John will give you a call. John, currently, I know this video is going to live on for a long time, but currently, where are you licensed in so you can help people?
Just currently in Oregon and Washington.
Great, great.
I'm hoping to add a few states as I go along. I'm new with AmeriFund. AmeriFund is a whole new opportunity for me, and I'm really loving it. So I expect to expand my states over the next year or so.
Oh, I love it. I'm sure you will. All right. Thank you so much, John. And we will talk to you next time.
Thanks, Christina. It was a pleasure.